Well, strong growth and persistent inflation have investors contemplating a new course for the economy in the coming year. A no landing scenario. You can read all about the newly coined outcome in today's morning brief over at the Yahoo Finance homepage. But for a deeper dive into what this means, let's welcome in Yahoo Finance's Alexandra Semenova. Okay, so forget soft landing, forget hard landing. What is no landing?
Yeah, so Wall Street has this new buzzword. We've been hearing it all week. It's the no landing scenario. It's a spin-off of the dichotomy of a soft versus a hard landing, one in which we see just a slowdown or a full-on recession. And in a no landing scenario, basically, the economy continues to grow while inflation stays persistently high, even as the Fed raises rates. And what's showing that markets are pricing this in is higher short-term rates and 1-year break-even inflation expectations rising and approaching 3%, particularly after the really strong jobs report, the strong retail sales numbers. And I've been talking to some strategists about what they make of this. And one really interesting perspective I got was from Greg Dacco over at EY, friend of the show. He said that this is nonsensical and basically that a no landing scenario is a non-event. So we know that the economy operates in a cycle. We see a period of growth and eventually it reaches a peak, then it contracts, hits a low, and then, we're back into an expansionary phase. And what he says is that basically, a no landing is just a delayed landing. And in fact, the longer we see the economy grow, the more, the higher the chances are that the Fed will continue to raise rates aggressively. And that actually increases the risk of a hard landing eventually. Nick Timeros at the Wall Street Journal, he put it well. He said that a no landing is a delayed landing.
Right, exactly. I've said I'm not a fan of the phrase no landing, but how the markets come up with this whole no landing idea and that they are now pricing it in to some degree.
Yeah, so, the Fed's extreme data dependence has kind of shifted the narrative over to markets. And so when we see these individual reports, markets are suddenly recalibrating their expectations really abruptly, getting the 500,000 jobs in January, getting the 3% retail sales number. These are actually outlier reports with a lot of seasonal distortions in them. And markets are suddenly adjusting their expectations and trying to figure out what's going on. Torsten Slok over at Apollo Management says basically no landing this year brings back the volatility that we saw in 2022 where, markets don't know what the Fed will do. But the thing is, this is another situation of markets not taking the Fed for their word. We have officials over and over saying that we're going to go to 5%, above 5%. James Bullard even at some point said 7%. So as long as we see, this continued growth, we will see more aggressive rate hikes and eventually we will get a landing.
All right, sticking on the topic of no landing, let's bring in our next guest who says that we may be running out of runway. Jim Bianco, Bianco Research President. Jim, great to see you as always. We'd love to get your take on our discussion here on no landing. Is it a real thing?
No, it is a real thing. I mean, no landing is basically, as you said, it's a takeoff on the metaphor about an airplane. And it just means that the economy's not going to slow down. It's not going to go in recession. It's not going to have a soft landing. It's going to continue to grow. And the fear is if it continues to grow, the Fed has no reason to cut rates. And there's heightened concern that inflation will not hit their 2% target because the economy is growing. And they might even continue to start raising rates. And you've seen that just this week now, the market is starting for the first time this cycle to price in more than what the Fed is suggesting. It's always been pricing in less. It's always been talking about pauses and step downs and pivots, but now it's pricing in more. And that we've got an expectation that the Fed's going to go to 5.5 in June. And it may not stop there if the economy continues to move forward.
Jim, maybe I'm just getting caught up in the language here, but the idea that no landing, I just hate the analogy because eventually the plane has to land, whether it's now, whether it's later, the landing has to happen, right? And I guess I'm just wondering, if it's not landing, are we looking at another decade-long economic expansion? It doesn't feel that way, does it?
No, it doesn't feel that way. But I think what people are expecting is that inflation, everything comes back to inflation. It's all about inflation. What they want or what they are hoping for, both at the Fed and on the street, is that the inflation rate's going to hit 2%. Well, the only way that it's going to do that, at least the belief is, the economy has to slow. And if it doesn't slow, then the inflation rate stays up. And if the inflation rate stays up, the Fed keeps hiking. And eventually they hike to some number, as you mentioned, Bullard, 7%, or whatever number it takes to actually break the economy. There's an old adage, the Fed keeps hiking until something breaks. I could summarize what I just said. we've raised rates to 5%, nothing's broke. So let's go to 6 and see if we break something. Let's go to 7 and see if we break something. Wherever we have to break something. So yeah, eventually the economy will land, but until it does, the heat's going to be on when it comes to interest rates. They're going to continue to stay up and maybe go higher.
Jim, on the topic of 2% inflation, I'm curious to hear your thoughts. So Fed Chair Powell said that he and his colleagues aren't going to budge on that long-term inflation target. But then some investors are saying that we're going to have to settle for 3 to 4%, that there are factors that interest rates can't quite fix, like, supply chains moving closer to home, making things higher, these post-COVID factors that will make us have to accept 3 to 4% inflation. Do you think the Fed will get back down to the 2% inflation target eventually?
Well, two things there. One, investors live in a fantasy land that they think that the Fed is going to redefine inflation at 3 to 4%. And I say that because Jay Powell could not have been more clear throughout the fall when he's been asked this question. They are not moving that target. Conversation over. You can stammer and you feed all you want that they should change it to 3 or 4% because you want the Fed to stop raising rates so they could start cutting rates so the stock market could go up. They're not going to do that. They're only going to stop when we get to 2%. Now, can they get to 2%? This is a very sticky problem. You mentioned supply chains. They're looking at, labor hoarding and tight labor markets with large wage increases. I've argued this is a post-COVID economy. Now, that's a fancy term. What does that mean? It's different. Everybody keeps talking about this is so uncertain. We don't know what's going on. The labor market's confounding everybody. Yes, because all the rules up to 2019 don't work anymore. We shut down the global economy. We reopened it. We need a new set of rules. We got to stop waiting for 2019 to return. And those new set of rules, what I fear, is going to lead to persistently high inflation. And we have to come to the reality that we are in a higher inflation and a higher interest rate world. But we don't want to do that. We want to say, change the target to 4%, cut rates, let the stock market go back to 5,000. Everything will be okay then. If we did that, 50% of the public has less than $1,000 of savings. They have no assets. They get killed if we accept higher inflation. We can't do that because it would be too painful for them. If it means tough markets, it means tough markets. And I'm just repeating what Jay Powell has said. You're very smart. You're very capable. You have assets. Deal with tough markets. I'm not going to send the people that shop at Dollar Tree to be consigned to 4% inflation because you had a tough year in the S&P. I mean, I'm trying to be as blunt as I can. That argument just is not washing, I think, at the Fed. And I frankly don't buy it either.
Jim, I like your bluntness. It fits with my vibe for me that I'm feeling here on Friday. For those investors on our platform that are buying into this notion of no landing, at the most basic level, what stocks will suck wind in that environment?
The fancy term is long duration assets. Those are assets that are most sensitive to interest rates. Now, that's technology, that's growth stocks. Why? Because they're supposed to earn a lot of money off in the future, not a lot of money now. And if you discount what is Zoom's profitability going to be in 10 years back in a higher interest rate, it's a lot less. So those companies get hurt. What it helps or what companies do better are companies that are making money today, this afternoon. Energy companies, industrial companies, consumer non-cyclical companies that make money right now because you don't have to discount that money back. We're not worried about how much they're going to make in 5 years. And so those companies will do relatively better. Last thing I'd say about people on this platform, I've argued that in this new post-COVID world, we're going to go back to something like the 90s. It's going to be more like stock picking again. It's not going to be buy energy or sell technology. It's going to be which energy companies you're going to buy, which technologies companies you're going to sell. We're so ETF driven. We just want to buy the sectors. We want the S&P to go up or the S&P to go down that we forgot about that it's 500 stocks and some of them can go up and some of them can go down. And it's been so long, like a couple of decades, that we're going to have to start to relearn the whole art of stock picking all over again.
I mean, just to pick up on what you were saying about, even if it's individual stocks within these groups, about energy and consumer staples, for example, those groups haven't done so hot this year, right? Because the paradigm, the view, the sentiment has not been what you're talking about. What's going to change it? What's going to convince people that no landing isn't real and that, things are not going to go as the market is pricing in right now?
Those companies haven't done so hot this year because up until literally a week or so ago, the idea was the Fed's going to stop. then they're going to pivot. Rates are going to go down. So all of the, the FANG stocks plus Microsoft, Nvidia, and Tesla, they've actually accounted for over half the gain in the S&P, just 8 stocks. And the other 492 have accounted for less than those 8 stocks. So that has been what has been driving the market. But if we're going to pivot now, use that Fed term, that we're going to see the Fed go beyond 5% to 5.5%, we're going to be worried that inflation is going to be sticky, then those FANG stocks, those growth stocks are going to suffer. And then all of those cyclical stocks and those companies that are making money today, not what are they going to make in 5 years, they should rotate back into being in favor.
Jim, you always crush it for us. Be sure to follow Jim on Twitter, Bianco Research. Always a good follow. Jim Bianco, Bianco Research President. Thank you so much. And thank you to our very own Alexander Semenova. Appreciate it.
Thank you.
Coming up, we have